In this lecture, we will talk about using the net present value rule, or NPV rule, to evaluate investment decisions. So a little background. In the summer of 2007, think back to the summer of 2007, real estate investor Burt Matthews was contemplating the purchase of a 48-unit apartment building. Now, the building was 95% occupied at the time and generated $500,000 in annual profit. The investors from whom Mr. Matthews was seeking to raise capital expected a 15% return on their capital. In addition, a bank offered to loan Mr. Matthews 80% of the purchase price for this apartment building at a rate of 5.5%. So he was going to raise 20% from investors who demanded a 15% return, and the other 80% from a bank that was offering him a rate of 5.5%. Mr. Matthews' total cost of capital, or weighted average cost of capital, needs to combine the 20% piece of the capital that expects or requires a 15% rate of return with the other 80% on which he's required to pay a 5.5% rate of return. We can calculate this weighted average cost of capital as 20% or 0.2 times 15%. That's the investors, the equity investors who are demanding 15%, plus 0.8 or 80% times 5.5%, representing the bank's rate of return, and the weighted average is 7.4%. Now, using this weighted average cost of capital, we can back into or back solve for the maximum price Mr. Matthews could pay. If he is generating $500,000 in annual profit, then the most he could pay would be $6.75 million. We can find that by dividing the $500,000 by the 7.4%. That gives us the $6.75 million. Implicitly, what this means is that if he pays $6.75 million and owes 7.4% on interest every year, that will equate to $500,000 in interest every year. In other words, if he pays $6.75 million, all of his profits will be used just to cover the interest expense. So that's the absolute most he can pay. He decided not to buy the building, and in hindsight, that was a good decision. What happened after 2007? Well, in 2008, as part of the global real estate and economic crisis, occupancy rates at this particular building fell to 90%, and that reduced the annual profits to only $450,000. In addition, the bank backed off of its original lending offer, agreeing to offer only 65% of the capital and at a higher rate, 7.5%. The new cost of capital, taking new percentages for the equity and bank investors, and the new rate offered by the bank worked out to be 10.125%, or 10 1/8%. At that rate, Mr. Matthews could pay a maximum of only $4.4 million, much lower than the ceiling that he had calculated previously. Now, this story illustrates a couple of things. It illustrates, one, the effect of the bursting of the credit bubble, but more importantly, it illustrates the relevant costs and benefits in any investment decision, and how those are tied to a number of factors, including the interest rate. The main point of this lecture is that investments imply a willingness to trade dollars in the present for dollars in the future. Wealth-creating transactions occur when somebody with a low discount rate, an individual who has a low rate or values at a very low level, future versus current dollars, lends to somebody with a high discount rate. Now, companies have discount rates just like individuals, and those companies' discount rates or costs of capital vary across companies. And companies will invest in, or should invest, only in projects that earn a higher return than their cost of capital. The net present value rule, or NPV rule, states that if the present value of a particular investment or a particular cash flow of a project is larger than zero, the project earns an economic profit and generates more wealth. It earns more than its cost of capital. Not all companies use the NPV analysis. Many use the break-even analysis because it's a little easier and maybe more intuitive, but only the NPV tool tells us both which projects are profitable and which are not, and how much economic profit or value is created or generated by a particular project. Investment profitability really boils down at a very basic level to future gain versus current sacrifice. All investments contain or represent this particular trade-off. Now, what does it mean to invest in a project with a low rate of return? I mean, other than the obvious that it generates a relatively low rate of return. Well, it implies that the person making that investment has a willingness to invest in projects with a low rate of return. That translates into a willingness to trade current dollars for future dollars at a relatively low rate. That's what it means if somebody is willing to invest in a low rate of return project. This is known as, or the terminology that we will use to describe this is having a low discount rate, which we will use R, or the variable R, to represent an individual or a company's discount rate. Individuals with low discount rates would willingly lend then to those with higher discount rates. And that's really a fundamental point to keep in mind as we talk about the NPV rule. Again, we said that this current versus future trade-off can be calculated by compounding current cash flows into future cash flows. Or, in other words, we can take a dollar amount today, let's let that be X subscript T, and if the rate of return is R, we can calculate an equivalent future dollar amount, X subscript T plus 1, by taking the current amount times 1 plus that discount rate or interest rate. Likewise, if we're compounding multiple periods into the future, we can take the current value and multiply it by 1 plus R every year we want to discount or accumulate that value into the future. And so a future value at time T plus S, if S is 5, let's say, that would be 5 years in the future, can be taken or calculated by taking the current value X subscript T and multiplying that by 1 plus the interest rate, 1 plus R, raised to the 5th power. We're raising that to a power, and that power is equal to the number of periods that we're compounding the cash flow. Likewise, discounting is the term that we will use to talk about taking a future cash flow and calculating the equivalent dollar amount today. 1,000 years, or 1,000 years is not the same as today. $1,000 1 year from now is not the same as $1,000 today. In fact, $1,000 today is more valuable. Not only for the certainty, but also for the time value. We can calculate the present or equivalent current dollar amount by taking the future dollar amount and dividing it by 1 plus the interest rate. That would discount that cash flow 1 period. Now, if we want to do it multiple periods, we take the future cash flow and divide by 1 plus R, or 1 plus the discount rate, that quantity raised to the S power, where S is the number of periods that we're discounting the cash flow. For instance, if my discount rate is 10%, would I lend or borrow to somebody with a discount rate of 15%? Well, what that means, if my discount rate is 10%, that if I have $1,000 today, I'm willing to trade that for $1,100, or 1,000 times 1 plus R, 1.10, that gives me $1,100. That's what I would be willing to trade it for. Somebody with a high discount rate would see $1,000 as equivalent to $1,150 in the future. So if my discount rate is relatively low and somebody else's discount rate is relatively high, it would be to our mutual advantage for me to lend them money and for them to pay that money back in the future. I would value $1,000 as equivalent to $1,100 in the future. Somebody else with a higher discount rate of 15% sees that $1,000 today as equivalent to $1,150 in the future. Somewhere between that amount, between the 10 and the 15%, we'll be able to come up with a rate that seems like a good deal to both of us. Now, companies can use or do use discount rates that are determined by their cost of capital. Their capital can be raised typically from one of 3 sources: debt capital, or bonds that the company has issued, preferred stock capital, or preferred stock that the company has issued, or common equity or common stock that the company has issued. All 3 of those types of capital have an associated investor, and that investor has an expected rate of return. The aggregate rate that the company is paying is a weighted or blended average of the rates on the equity, common equity, preferred equity, and debt capital, and the proportions of the capital coming from each of those three sources. And that blended or weighted average is known as the WACC, W-A-C-C is the acronym Weighted Average Cost of Capital. So when you see the acronym WACC or WACC, that's all that it's referring to. We will use the weighted average cost of capital extensively to evaluate investment decisions because the interest rate or the weighted average cost of capital represents the hurdle rate or the minimum rate that the company needs to earn on its investments for them to generate or add economic value. Now, time is a critical element in any investment decision. The cash flows received in the future need to be discounted to the present, or if we're looking at cash flows in the present, current values need to be accumulated. Typically what we'll do is if we have a stream of cash flows, we'll calculate the present values of all of those cash flows, taking oranges and apples and making them all current cash flows so we can compare and add apples to apples. Think of future values and current values as apples and oranges. They can't be added together. We have to adjust them, and then we can add present values that all line up at a particular point in time. The NPV rule states that if the present value of a particular cash flow or set of cash flows is larger than zero, then the project is profitable and adds money. Calculating a company's cost of capital is not necessarily a simple matter. There are proper methods, but these proper methods are subject to some debate. So there's not a single purely black and white, cut and dried method, although there are some general rules that one can use or a company can use to calculate that cost of capital. Let's look at an example. Here we have two projects, Project 1 and Project 2, and both involve an initial cost of $100 million. So the outflow at time zero represents the investment that's required, and we see that both of these projects require a $100 million investment. Now, what's different is the timing and the amount of the cash flows. Project 1 has a cash inflow of $115 million at time 1. Project 2 has a cash inflow of $60 million at time 1 and a cash inflow of $60 million at time 2. Now, it might be tempting to just look at these and conclude that Project 2 is the better project. After all, it is true that if we add up the positive and negative cash flows for each project, Project 1 has $115 million of positive and $100 million of negative, so the positive outweighs the negative just on pure numbers by $15 million. Whereas with Project 2 has total positive cash flows of 60 plus 60 or 120, negative of 100. The positive outweigh the negative by 20, the 120 minus the 100. So it would be tempting but incorrect to conclude that Project 2 is the better project. Why is that? I mean, after all, Project 2 does generate more in the way of positive cash flows. And the answer is the cash flows are not occurring at the same point in time. In other words, we're dealing here with apples and oranges, time 1 and time 2 cash flows. In fact, we're dealing with apples, oranges, and kumquats because we have time 1, 2, and 3 cash flows, or time 0, 1, and 2. We've got 3 different time periods. We need to put everything on an apples-to-apples basis. That requires discounting the cash flows from the time they occur to time 0. And now in order to do that, we need a discount rate. Let's assume that 14% is the required rate of return on both of these projects, and therefore the appropriate rate to use to discount the cash flows. Now, you should pause this recording and see if you can match the numbers down below. Those are the present values of each of the cash flows taken by first starting with the actual cash flow itself and then dividing by 1.14, that's 1 plus the interest rate, for time 1 cash flows, or by 1.14 squared if we're taking time 2 cash flows and discounting those to time 0. Now what you can see, or what we can see from the bottom 2 rows, is that the initial investment occurring at time 0 has a present value equal to its dollar amount, $100 million. But what's different is the present value of the actual positive cash flows occurring at time 1 and time 2. The present values are listed in the bottom 2 rows of Table 1. The present value of $115 that occurs 1 year from now is $100.88. So for Project 1, we see that the present value of cash inflows exceeds the present value of cash outflows by $0.88 million, just a little less than $1 million, but it's positive. That tells us that this project earns a little more than the 14% required rate of return and will add economic value. On the other hand, project 2, which remember did have higher total cash flows, just the total cash flows 60 plus 60 or $120 million seemed not only like a good investment, but possibly even a better investment than investment 1. We see that when we calculate present values, that's not the case. The present value of the two cash flows occurring at time 1 and time 2 are $52.63 million and $46.17 million. In total, those add up to less than $100 million. In fact, they add up to $98.8 million. In the case of project 2, the present value of the cash inflows is actually less than the present value of cash outflows, and project 2 has an NPV of negative $1.2 million. That tells us a couple of things. It tells us that it earns a rate of return that's a little bit less than the 14%. It tells us that it's going to actually destroy value if the firm undertakes it. So the NPV rule, NPV analysis, net present value, remember, equal to the present value of cash inflows minus the present value of cash outflows, whether that's positive or negative, tells us a couple of things. Projects with a positive NPV create economic profit, and only those projects that earn a positive economic profit are those that are earning a rate of return above the company's cost of capital. Projects with a negative NPV project, they may create accounting profits but not economic profits, and ultimately they are generating a rate of return that is below the company's cost of capital. Therefore, for a company to create economic value, they should invest only in projects with a positive NPV. Thanks for listening.